Hello guys, you're watching Alpha Ambition and welcome back to another very important video which is on best 5 ETFs to invest in Canada in 2022. Now if you've already invested in ETFs or thinking about investing in ETF, chances are that you may actually already know that ETFs are a low cost, low hassle, tax effective way of achieving primarily two objectives. First, diversification, which is key and which is very important, and second is investing in an idea. Now that idea may be investing in the total stock market or investing in the stock equities of a specific market, for example emerging markets, or investing in some forward-looking ideas like clean tech, renewable energy and healthcare. Now as we speak, there are more than 800 ETFs that are available to the Canadians to invest in the Canadian financial ecosystem. So in today's video, I'm gonna make that easy for you. So please do stick around until the end of the video. Now without any further ado, let's get started. Alright, to set the context right for this video, the approach that I'm following in shortlisting the best 5 ETFs to invest in Canada in 2022 is A. We're focusing on diversification, which is a key. Anytime you're selecting any ETF, you should definitely look at diversifying your risk. And second, we're going to be looking at investment in indexes or industry that have a reasonably good potential to grow in the next coming years. Now with that approach in our mind, let's begin with number 5 on our list, which is ticker symbol ZCN, and the name is BMO TSX Capped Composite Index ETF. Now the name is pretty confusing. I don't know why these guys keep these kind of names, but essentially what it really means is that this ETF is designed to replicate the performance of over 200 top-rated Canadian stocks representing about 95% of the Canadian equity market. So essentially, ZCN invests in the entire Canadian equity market, thereby spreading the risk over a variety of equities. Now very quickly, the reason that I like this fund is that it is designed for investors looking for growth, and it gives exposure to a mind-whopping 241 diversified Canadian equities. And the expense ratio is among the cheapest that you can find in the ETF market today at 0.06%. The fund size of this ETF is at $7+ billion Canadian, and this is very important because the higher the fund value, higher will be the liquidity. So it'll be easier for you to sell the ETF whenever you want it to. Alright, with that out of the window, let's talk business. Let's talk about the performance. And for each of the ETF that we'll be talking about today, we will be looking at their 10-year performance. So the cumulative 10-year return of ZCN is at 133%. What really means is that a $10,000 invested in this ETF 10 years ago would become $23,284. In addition to that, there is another way this ETF puts money back in your pocket is through a year-over-year dividend yield of 2.67%. Now this is a true passive income you're earning by investing in this ETF. And as I mentioned in the beginning of the video, since this ETF invests in the entire Canadian equity market, the risk is very well spread, and hence the risk rating of this ETF is at medium. So guys, if you like number 5 on our list so far, I'm gonna promise you that the things are getting better from here. So please do stick around until the end of the video because there's more value coming your way in terms of both the 10-year returns and also the dividend yield that you can earn as a true passive income. With that, move on to number 4 on our list, which is VDY. VDY ticker symbol is FTSE Canadian High Dividend Yield Index Fund. Number 4 on our list specifically focuses on the best Canadian ETF right now from a Canadian high dividend yield perspective. So what it really means is that this ETF tracks the performance of Canadian equities that usually pays a high dividend yield. Now some of the benefits of this ETF is that it gives you exposure to over 39 Canadian stocks and has an expense ratio which is not too high, not too low at 0.21%. The fund size is also decent at about $1.7 billion Canadian. Now with that in mind, let's talk business, the performance of this ETF in the last 10 years. So this ETF VDY has given a cumulative 10-year return of 157%, which means that a $10,000 invested in this stock, in this ETF about 10 years ago would have become $25,500. And not just that, this gives a handsome year-over-year dividend yield of 3.5%, which is truly marvelous. The risk level for this ETF is on a higher side because this only invests in 39 equities. But if you're somebody who is trying to allocate a portion of your portfolio towards an ETF which earns you a decent level of dividend, this is the ETF for you. Now, before you write off this ETF, considering this a high risk ETF, let me tell you that this ETF invests largely in the large cap stocks, which are usually financially stable companies, and very small percentage of the ETF allocation goes towards medium and small cap stocks. And further, to pacify your risk related concerns, this ETF invests largely in the top 5 Canadian banks and some of the most stable companies in the Canadian markets today. So these are very well established businesses that also pay a handsome dividend yield at the end of the year. Alright, let's talk about number 3 on our list, which is the ticker symbol VDC. This is another Vanguard ETF on our list, and the name is Vanguard Consumer Staples ETF. Now, one thing you may ask is that why do I have a USD ETF on my list today? Well, guys, this is pretty simple because anytime that you're crafting your investment portfolio, even though you're not a risk-averse investor, it doesn't mean that you invest entirety of your sum into high risk, high reward ETFs or stocks. You should always have a certain portion of your stock portfolio or investment portfolio allocated towards some of the stable businesses that may not appreciate ballistically in the short run, but at the same time, they preserve your portfolio in terms of any market crash. Now, the Vanguard Consumer Staples ETF helps to provide that stability to your portfolio because consumer staple businesses are the businesses that usually do not get affected much by recession or by an economic downturn, because these are the things that people need on a day-to-day basis. You may stop your travel, you may stop spending on discretionary items, but you wouldn't stop buying toilet paper or toothpaste or some of the other grocery items. And that is the reason we have Consumer Staples ETF on our list. Now, some of the benefits of this fund is that it gives exposure to about 99 US consumer staple stocks, and the expense ratio of this one is particularly on a lower side, which at only 0.1%. The fund size is pretty huge at $7.6 billion US. Now, looking at the investment holdings of this ETF closely, you can see that the fund invests in some of the most known and stable companies in the world today. Procter & Gamble, Costco, Coca-Cola, Walmart, Colgate are some of the examples. Further, talking about the performance of this ETF, and this ETF has given a cumulative 10-year return of a handsome 211%, which means $10,000 invested in this ETF 10 years ago would have become $31,112. And the fact that this ETF invests in some of the most financially stable companies, the year-over-year dividend yield of this ETF is at about 2.6%. And again, given the nature of the business, I would consider the risk level of this ETF to be somewhere in the medium range. While number 3 on our list was focusing towards providing that stability to your investment portfolio, the number 2 ETF on our list today aims to provide you exposure stocks in the US market. So ticker symbol VFV is the Canadian version of the Vanguard S&P 500 Index ETF. This ETF seeks to track the performance of US equity index and measures the investment returns of 500 large cap US stocks. Let's quickly look at the benefits of this fund. It is designed for investors looking for growth, and growth coming from some of the largest and most stable and innovative businesses in the US, which are the S&P 500 companies. It gives exposure to 507 diversified US equities at the expense ratio of just 0.8%. Now, this 0.8% translates to only $8 for a $10,000 investment made in a full single year. Now, the fund size of this S&P 500 Index ETF is at $6.6 billion Canadian. The ETF VFE was founded in 2012, and the 10-year cumulative returns on this ETF is at a mind-whopping 372%. So a $10,000 invested in this ETF 10 years ago would have become $47,127. This ETF largely invests in large cap stocks, although there is some representation of mid and small cap stocks, but that is relatively small. Now, looking at the holdings of this ETF shows that it invests in the best and the biggest companies in the US stock market, including Apple, Microsoft, Amazon, Tesla, Nvidia, so on and so forth. Given the exposure to a large variety of US stocks, the risk level for this ETF is at medium. Alright, so number one on our list of the best 5 ETFs in the Canadian market today is QCLN, which is the First Trust Clean Edge Green Energy Index Fund. This ETF invests in the companies which are involved in generating clean energy. Now, the eligible companies must be manufacturers, developers, distributors, or installers of advanced materials that goes into generating clean energy, or smart grids, energy storage including hybrid batteries, and renewable electricity generation through solar, wind, or geothermal, etc. Now, looking at the benefits of this ETF, number one has to be the fact that this is an industry which is going to explode in the future, given the amount of investment that this industry is garnering from various different sectors, and the fact that clean energy is the only way forward in the future. This gives exposure to large, medium, and small cap stocks, and to over 60 stocks primarily in the US stock market. The expense ratio for this ETF is medium to high at about 0.6%, which means a $60 of management fee if you invest $10,000 in this ETF in one full single year. The fund size for this ETF is at US $2.23 billion. QCLN has seen a massive 395% cumulative return over the 10 years period, which means a $10,000 invested in this ETF 10 years ago would have become $49,500. Now, given the fact that this is a growing industry, companies do need a lot of cash to reinvest in their business so that they keep going on the growth trajectory, which is the need of the hour. For that reason, do not expect any material dividend yield on this ETF. This ETF is primarily about growth, and the growth not just in the next 1 year, but a consistent growth over the next 5, 10, 20 years. Now, looking at the stock holding of this ETF, the majority of the companies that this ETF invests in are in the United States, China, Hong Kong, Canada, and Chile. And looking at the top 10 holdings of QCLN, we see some of the most familiar names like Tesla, Solar Edge Technology, and Brookfield Renewable. Personally, I believe that the returns that this ETF has seen in the last 10 years can actually multiply and even become higher in the next 10 years from now, because ESG, sustainability, and topics of clean energy is only picking up momentum with every passing year. And also, the risk level for this ETF is also on the higher side. And that is all for today's video, guys. Hope you like the content. Hope you've been liking the content that I'm making so far. I do have a lot of highly recommended content on this channel. I know this is a relatively new channel, but I have loads that I've planned for the future, and I intend to provide all of that information with analysis in easy to understand language. So please do support the channel by sharing your love, by liking, sharing, and subscribing. And in the meantime, do take very good care of yourself, and I'll see you in the next video. Thank you and bye-bye.